So I currently have about $14,000 of staked SOL, which is earning about an 8% APY. Now I'm borrowing against this, so obviously I can get some leverage on this. I have USDC borrow, which I then usually take and convert to either SOL or Render or Pyth, something like that, to accumulate more assets and of course make more money as the price goes up. It's a simple form of leverage, but what I really want to showcase to you guys is how you can earn high yields on SOL, and something that I'm actually doing in my own portfolio. I'm doing this through Kamino Finance as well as Jupiter, basically. So Jupiter is an aggregator, but they're also like kind of this all-in-one DeFi platform for Solana trading. Not only do they have like spot trading where you can execute, a USDC for SOL trade or one asset for another asset kind of trade through a normal liquidity pool or concentrated liquidity pool. They also have something called perps, which is perpetual trading. So this is where you can go and actually leverage up if you wanted to execute a leverage trade. Like for example, if I wanted to take a 100x trade on SOL, let's just say, and use USDC as collateral, let's just say I had $1,000, I would be able to accumulate 417 SOL tokens for $1,000. Now, obviously, if the price of SOL were to go down 1%, well, guess what? I am going to lose my entire $1,000 because I have 100x leverage. So that's kind of what this allows you to do. You can also go short if you really want to, if you're expecting SOL to go down for whatever reason. There's also an earn section to it where you can provide liquidity. And this is exactly how the protocol functions, because if there was no liquidity, then of course you would not be able to execute those leverage trades. Now, this is a little bit different than the standard liquidity pool where somebody buys one asset for you and they give you the other asset, basically. What you're actually doing here is underwriting the trades, because if somebody executes, let's just say $1,000 trade, and they turn $1,000 into $2,000, you are giving them the extra $1,000. Not you in specifically, but the liquidity pool, basically. So for example, there's $1.5 billion in TVL. If traders were to go on a winning spree and win $500 million in their trades, basically over the next month, this TVL, assuming the prices of the assets did not adjust, would go down to $1 billion because the traders extracted $500 million in TVL. Now, the beauty of this model is traders oftentimes lose on their trades. They don't win a lot. The majority of the time, traders are actually losing money, which means that the ball is in our court. It's in our favor, basically. Now, already off the bat, you can get roughly a 65% APR, but since this pool is automatically compounded, you're actually getting a 90% APY, which is great. But I'm going to show you how to get better than that, how I'm currently getting a 125% APY on this. And before I do that, I want to talk about how this actually functions, because again, this $1.5 billion is comprised of a couple different assets. We have SOL, which is basically 45% of the $1.5 billion. We have ETH, which is basically 10%. We have wrapped Bitcoin, which is roughly 11%. And then we have USDC and USDT, which equal to about 32-33% cumulatively. So basically, if we were to do the math on this, 68% of this pool right here is in crypto assets that are exposed to the market, not stablecoins. Which means as those assets go up, well, guess what? The price of the pool or the TVL is going up, which causes us to make money. As the price goes down, well, guess what? We are losing money. And when the traders win money, we pay them out, basically. Once again, it's not a huge risk here because oftentimes traders lose money on their trades. But at the same time, when traders lose money, they're actually giving us money. So this TVL is increasing. So it's actually even more in our favor, because if traders were to lose $500 million over the next month, this TVL is going to go up to roughly $2 billion, even if the underlying assets stay the same exact price. And of course, 75% of the generated fees from position opens, closes, price impact, borrowing fees, trading fees, and any other type of fees are going to go directly over here to the people providing liquidity for JLP, just as if you were in a normal liquidity pool. So that's the interesting thing here. By being in this pool and earning a 90% APY off the bat, you still do not have full exposure to the cryptocurrency market. You only have partial exposure to the cryptocurrency market. So we can then go and we can take this JLP token, because that's what it is. It is a token that is backed by these underlying assets, and we can put that up as collateral over on Kamino Finance, and we can borrow against it. What can we do with that borrowed cash? We could go and convert it into more JLP, basically, and leverage up. Now, the beauty of this is Kamino understands its user base, and they actually make it possible for you by just going over to the multiply section and executing on this leverage yourself, basically. So all you have to do is go over here, make a deposit, select your leverage, and then boom, you are deployed. Now, they have two different options right here. They have one where you collateralize JLP and you borrow USDC, the other where you collateralize JLP and you borrow PYUSD. Now, with that being said, I am actually using the PYUSD one because I typically find a little bit better return over here on the PYUSD one because it costs less to borrow PYUSD, basically. Anyways, if we were to dive into this actual pool, let's just say I wanted to do 1,000 JLP, which is currently worth about $4,200. I would select my leverage. In this case, I'm using 1.6x leverage, and then boom, I'd be able to execute on this position. As you can see, I can adjust that leverage all the way up to 3.2x. Now, I personally don't recommend going max leverage because the market does move not in your favor. You could end up getting liquidated. But with that being said, it would take my APY from 125% all the way up to 213% if I were to use max leverage. But again, it all comes down to not getting greedy in the markets like this. Now, one thing that I also want to go ahead and show you is the impact of leverage, right? Because it's not what you expect. Remember, most people think if we're using 1.5, 1.6x leverage, well, whenever the market goes up, let's just say 10%, we're going up 16% because we're using 1.6x leverage. Well, in this instance, that's not the case because remember, this only has about 68% exposure to the market. If we were to go ahead and use this spreadsheet that I created, it's actually about 67%, but that's not the case because remember, this only has about 67% exposure to the market because 45% is in Sol, 11% is in ETH, and 11% is in wrapped Bitcoin. The other amount doesn't really matter because that's not going to go up and not going to go down, which means if all of these assets right here exposed to the market were to go up 10%, we are only going up 6.7%, right? Because they don't make up for the full composition of the pool. So that's where the beauty of leverage comes into play, because if we were to use 1.6x leverage, well, not only is that going to leverage our yield from 90% all the way to 125% or a little bit less because we do have to pay borrow cost, it's only actually going to leverage our crypto asset exposure to 107%, which is in theory 1.07x leverage. And that's because we don't have full crypto exposure. So the beauty of this strategy is by saying, hey, by leveraging up, we're getting full exposure to the market, right? Yet we're getting an absolutely astonishing yield, which is at 125%. So this 1.6x leverage is taking us from having 67% market exposure all the way up to 107% market exposure, which means if these assets right here, these three, were to equally go up 10%, we are going up 10.7% by having leverage, as opposed to only going up 6.7%. Now, if we were to use something like 2x leverage, well, if these assets were to go up 10%, we're going up 13.4%. Now, remember, the opposite here is if the market goes down, well, we're going to go down a little bit more. We're going to go down, in this case, 13.4% if the market were to go down 10%. So do keep in mind these risks. But this is a relatively safe play, in my personal opinion, because you could leverage up without necessarily leveraging up on your market exposure, but you can get a substantially higher return. And this is something that I've actually been doing for quite some time. I've had this position for, I want to say, about a month and a half now. I started with about 10,000 bucks, and now I got about 14,000 bucks nearly, doing 125% APY, and I have a profit loss of 3,500 bucks, which is pretty great. And again, these are positions that we come across all the time in DeFi Excel. We're having conversations on a daily basis about these positions. So if you guys are looking for a community to keep you informed in DeFi and help you get started and help you start earning returns like this, and I highly recommend you check out the link in the description. Anyways, with that being said, if you guys have any questions on what I'm doing in my strategy with this JLP leverage vault over on Kamino Finance, let me know down below in the comment section. And again, I hope you guys did enjoy this video and found some value in it. If you did, drop a like and subscribe, and make sure you turn on notifications so you never miss out when I post a video. And just something that I also wanted to point out is there are Kamino Finance token airdrops. So I currently have about 1.58 million points. I'm not even sure what this actually does. I'm not sure how much allocation I might get, but I am farming an airdrop by being in this position, which is great because that's just an additional benefit. And again, in the effort of transparency, I just want to outline the risk one more time. Number one, you have smart contract risk. You will always have that being in any DeFi position. It's not a huge risk considering that there's $1.5 billion in Jupiter and there are multi-billion dollars in Kamino Finance. So just keep that in mind. It's still there, but it is a lower risk because they do have a high amount of capital in here and they have been audited before. But not only that, you have exposure to the cryptocurrency markets. So if these assets rise or fall, you will have exposure to that. The other thing that you have exposure to is, of course, traders' profit and losses. If traders go on a huge winning streak, or maybe just one large trader comes in and wins a huge trade, that's going to be paid out through this TVL right here, basically. And that's because you are underwriting trades. But the vice versa is, of course, if traders start losing their trades, well, then they're going to start to pay you out, which is the beauty of it. And of course, if you are using leverage, you have leveraged exposure to the JLP asset, which can introduce liquidations if you are too high leverage and there is high volatility in the market. Hope you guys enjoyed today's video, and I will see you guys in the next one. Peace out.